we could see silver spike and pop and really take off to 100. We actually hit 82.50 just 2 days ago, and then it sold off fairly dramatically. We could have a big reversal at any point. It's like a bearish engulfing candle. The red body completely engulfs the previous day. I wouldn't say it's over. All it is telling us is like things are getting really wild. We've seen margin increase twice on silver, kind of a warning flag in my head. I'm watching this chart like a hawk along with other metals here because I'm potentially going to be liquidating some of my metals at some point. If margin requirements go up, they have to liquidate all kinds of different positions just to cover their silver positions and things like that. It's going to become the new floor for silver. Maybe down to 40 to 50 will be the new floor. Right now we're in bubble phase. So silver can pop and take off. And I do still think we could see one big push in silver. Could spike potentially, past 100. I still think we could see gold move up to 51, 5,200, and then I think it's going to pull back. I think that's going to happen in 2026.
Silver has had a monumental run in the last week, running up to $80 and then falling, I think, double digits, 15 to 16%. It hasn't fallen this much in a single day intraday trading session since, I can't remember the year, but it was a long time ago. So this very sharp rise to 80 and then a very sharp reversal back to 72. I mean, it's still high, right? It's still like 72, but the quick reversal, that was a scary drop. And now silver is stabilizing around 75. So big green candle, then a big red candle, and then a smaller green candle is what I see on my screen. I'll let you share your screen and walk us through what you're looking at here. Yeah,
well, there's definitely been some pretty amazing moves in the precious metal space. I think all of us have been waiting years for everything, especially silver, to really pop. And of course, silver has done that. As you just mentioned, if we look at the last three candles that we've seen, we saw like a 11% rally one day, then a massive reversal. We actually had $82 as my kind of blow off spike high, and we actually hit 82.50 just 2 days ago, and then it sold off fairly dramatically, and now we're getting that bounce.
The violent move isn't the story. The speed of the reversal is. Silver didn't just rally, it printed an 11% single-day candle and then erased nearly 16% almost immediately, something Chris Vermeulen notes hasn't happened in years. Historically, when silver shows this candle sequence, expansion, exhaustion, partial recovery, volatility clusters rather than disappears. This is where late momentum traders get trapped while professionals reassess risk. The stabilization near 75 doesn't mean safety, it means indecision after emotional excess. The next move is usually sharper than expected. And what Chris Vermeulen explains next reveals why this kind of bounce can be more dangerous than the drop itself.
So there's a lot going on. It's not just in silver, it's in the whole precious metal space. You and I have touched on this, that when you look at the comparison of 2007 and what miners have done, what platinum, palladium, and silver have done, we're definitely seeing everybody starting to really move into this space who wants to get in. And it is starting to feel really frothy. As exciting as it is, and people think it's just getting started, the charts are actually showing signs that it's actually starting to become exhausted. And this type of red bar, that is a pretty scary red bar, is one of those signs that we're getting close to maximum kind of volatility and some type of blow off top. Now, there are reasons for this. We saw silver have a margin call a little while ago, increase in margin. We also saw it again yesterday, which is, I think, a very big reason why we saw precious metals across the board sell off. Whoever's in silver, they're generally into a lot of other metals. And if margin requirements go up, they have to liquidate all kinds of different positions just to cover their silver positions and things like that. So we saw a lot of selling yesterday based, I think, a lot on the margin requirement that was increased on the COMEX.
This is where Wall Street never tells the full story. Margin pressure, not fundamentals, often triggers the sell-off. As Chris Vermeulen highlights, rising margin requirements force liquidation across metals, silver, platinum, miners, regardless of conviction. That's exactly what happened in 2007 before the peak, when frothy participation masked structural stress. A single margin hike can unwind leveraged exposure fast, and COMEX margin increases have a long history of ending parabolic runs. When charts show exhaustion, but headlines scream early innings, that's usually late cycle behavior. Chris Vermeulen talks, what matters next is not enthusiasm. It's who's forced to sell if volatility spikes again.
But, when we look at a couple of these other plays real quick, like platinum, if you look at platinum, look at the big kind of volatility we saw percentage wise, in like a 4-day window, it moved up 22%. In a 1-day window, it dropped 18%. And we still have the similar type of price action for palladium. And of course, just huge price action. Of course, everybody's talking about it. Everybody seems to be wanting to get into this space. Who is open to investing? I'm not saying all investors are moving in. I'm just saying those who are more or less open to the concept of adding and trading precious metals, they seem to all be piling in. And when they do that, we get into this back and forth price action. And silver is very exciting. I mean, I own a lot of physical silver. I now have kind of a warning flag in my head. I'm watching this chart like a hawk, along with other metals here, because I'm potentially going to be liquidating some of my metals at some point, depending where the market caps out. So people need to be aware this type of volatility is usually a sign that we're getting close to an end, but some of the biggest moves percentage-wise do happen at the very end of a trend.
When everyone who's open to metals piles in at once, risk quietly shifts from upside to timing. Platinum moving 22% in 4 days and then dropping 18% in one isn't healthy momentum. It's liquidity stress. Chris Vermeulen's warning flag matters because seasoned investors watch volatility, not excitement. Historically, the biggest percentage gains often come right before trend exhaustion, not at the beginning. This is where retail chases headlines while long-term holders quietly plan exits. Physical ownership doesn't remove market risk. It delays the decision. Next, Chris Vermeulen talks what forces investors to choose between conviction and discipline.
We could see silver spike and pop and really take off to 100. It's not about trying to pick or nail a top. It's about just following the trend. The trend is clearly still up. It had a big down day, but it's recovered and now it's back above the 5-day moving average. So the trend is still firmly to the upside. It's just got a lot of volatility in there now.
Whenever you see, just from a technical perspective, anything move up and down like this, let's just take silver and palladium as examples because you have both of them on your screen. And you've got these big red bars followed by a smaller bounce. What do you do with that information? Because on the one hand, you've got this continuous uptrend that's still intact. And on the other hand, you have this giant 1-day washout, or maybe multi-day in the case of palladium, that was followed by some sort of consolidation and then a slight bounce up. Does that signal to you that the rally is over? Is that why we had that giant red bar, Chris?
I wouldn't say it's over. All it is telling us is like things are getting really wild. We've seen margin increase twice on silver. It just means there's a lot going on and we need to be aware.
This is the uncomfortable truth. Trends don't end cleanly. They fracture under volatility. Silver reclaiming its 5-day moving average keeps the trend intact. But the violent washout candle is a warning, not reassurance. As Chris Vermeulen notes, repeated margin hikes compress upside and magnify downside risk. In past cycles, these still bullish phases often lure investors into late-stage exposure while volatility does the damage. Palladium's multi-day washout shows how fast sentiment can flip. Staying long here isn't wrong. Staying blind to risk is. And what Chris Vermeulen explains next reframes why trend following alone isn't enough at this stage.
We could have a big reversal at any point. Now, you're right. This type of bar, when it gaps higher and then pushes up and then gets slammed down and closes below the previous day, that is like a bearish engulfing candle. The red body completely engulfs the previous day. It went higher. It closed below it. It's usually a reversal candle. Now, a reversal candle is only good for 1, 2, or 3 more bars after it. It doesn't, specifically mean it's the top for silver. The big thing with this inside bar, as you mentioned, this big red bar, is now price is going to trade sideways in here for a little while, and we need to see which way it's going to resolve. you're right. This is a bearish bar. Price might consolidate sideways here inside this range, and it could easily break down and have a bigger pullback before it maybe wants to go higher. And there's a really good example. Like if we just take a look at silver and use the Fibonacci extension here, we go from the low that we had over here. We had this big run up, this peak, and then we come down. And we talked about, well, maybe, I don't know if I talked about it with you. I probably did. But we had this target around 72 to the upside for silver.
The most dangerous part of this move isn't the drop. It's the false sense of stability that follows it. As Chris Vermeulen explains, a bearish engulfing candle statistically carries signal strength for only 1 to 3 sessions, meaning traders often misinterpret it as a long-term top when it's actually a volatility marker. Historically, silver consolidates after these candles rather than immediately collapsing, especially after parabolic runs. The Fibonacci target near 72 matters because measured moves often attract algorithmic selling and profit taking from institutions. Sideways action here isn't neutral. It's a decision zone where risk quietly builds. Next, Chris Vermeulen determines whether this was exhaustion or merely a pause.
That is the Fibonacci measured move, just based on this move up, the big correction, and then of course the 618 and the 100%. And once you hit that level, that's a level we locked in 20% gain. We were long an SLV trade with one of our strategies. We closed out a trade there. And then of course, price got into this kind of blow off phase, this emotional move. And this is what happens when you hit these Fibonacci targets and then suddenly the crowd jumps in and creates this volatility. That means the price charts are painting a very clear picture of what's going on.
I've heard silver could go as high as $100 in 2026 before a reversion. The fact that it's seen significant resistance at 50, sustained above 50, and then now we're seeing obviously resistance at 80, I wonder how likely 100 is. Now, of course, the higher it goes, the more likely $100 in triple digit silver becomes because the percentage gain is smaller. The elusive $100, what needs to happen for the price to hit that target this year, Chris? If it will, maybe that's not your view.
Well, yeah, it depends on how you look at it.
When Fibonacci targets hit, headlines scream breakout. Professionals quietly take profits. Locking in a 20% gain at a measured move isn't fear. It's discipline. And Chris Vermeulen's exit highlights how institutions trade levels, not stories. Historically, silver stalls after clearing major round numbers, 50 and now 80, because options flow and hedging activity intensify there. The $100 narrative ignores that most commodity spikes reverse after emotional blow-off phases, not extend smoothly. A smaller percentage gain doesn't mean easier upside. It means thinner liquidity and faster reversals. What Chris Vermeulen explains next exposes why triple-digit silver isn't a straight line bet.
I do think silver could spike dramatically higher. I mean, when you look at the log scale and this giant bull flag pattern, I mean, this isn't a pattern I've ever really showed anywhere because it does point to some crazy high pricing for silver. So based on this run up from the 2000 low and the big pullback, it's really just breaking out of the high that we saw back in 2011. This tells us kind of, that upside target. It's 57 was the upside target for it. And then we had to drop down to intraday charts, which you and I did in a previous video that pointed to around 72. Right now we're in bubble phase. So silver can pop and take off. And I do still think we could see one big push in silver could spike potentially, past 100 very quickly. I think it could be short-lived. I think it'll be an emotional driven move. It'll be pure FOMO. Everyone piles in to get involved. And then it'll probably reverse and come back down. But I do believe in what you said and some of your other guests saying, once it does top out and pull back, I do believe it's going to hold above 50.
Log scale breakouts look powerful, but they often hide how unstable late cycle moves really are. Breaking above the 2011 highs is technically meaningful, yet Chris Vermeulen openly labels this a bubble phase, a word rarely used at tops until volatility forces honesty. In past silver cycles, FOMO spikes above resistance levels reversed within weeks, not months. The idea of holding above 50 after a blow-off aligns with long-term structure, but short-term capital can still suffer deep drawdowns. Investors need to separate structural support from emotional price extremes. Next, Chris Vermeulen shifts from price targets to the psychology that usually ends these runs.
I think it's broken that threshold, and so now I do think it's going to naturally, it's going to become the new floor for silver. Maybe down to 40 to 50 will be the new floor, which is great, and it'll build a base. And then I think over time, when it starts to break out, then we'll be off to the races to 100 plus for silver. I guess again, I'm really bullish on metals. It's just short term. I'm getting a little nervous, and we just have to let this bubble burst. And then we're just going to have to digest and wait for the next foundation, like the next base like this to build out. Does it take 6 months? Does it take 5 years before it starts that next big run? We don't know. But the volatility and the crowd psychology of people moving in is telling us we're on the last few bars when it comes to the monthly chart. We probably have 1 or 2 bars left, and we're going to see the metals probably top out across the board for potentially a year or so.
Long-term bullish doesn't protect you from short-term damage when cycles exhaust simultaneously. Calling 40 to 50 the new floor assumes patience, yet Chris Vermeulen warns the monthly chart may have only 1 or 2 bars left, a time frame many investors ignore. Historically, metals entering digestion phases can spend 12 to 24 months chopping sideways, tying up capital while other assets move. Crowd psychology peaking together across metals often precedes synchronized pullbacks, not selective ones. Being bullish doesn't mean being fully invested, it means surviving the reset. Next, Chris Vermeulen talks. What comes ahead is about timing, not conviction.
And we did the exact same thing with gold. If you look back at gold, and we just go back to this previous chart right here, it's just amazing how these charts, play out. We had the rally up, and then we had this pullback, and we carried this over. And so we got long gold for a quick trade with 15% right up to our target here. It had the hiccup, and then it had the blow off phase before it went into a big correction. So the market, it's kind of rotating. We're seeing it happened in gold first. Now it's happened in silver, platinum, and palladium. Gold has had a pullback, a fairly sharp pullback for gold, but overall it's still, has a stronger chart pattern. But the charts are really strong here, saying that the trends are still up, but there's a lot of volatility. And people, I think, there's other two camps. There's other people who just buy gold and they keep it forever. And, they think the world's going to fall apart and all that stuff, and they're never going to sell it. And then there's other people who want to try to navigate it and trade it. And we could see a very big correction in 2026 in the precious metals space, which I think is going to be a huge opportunity. And I don't believe in holding something if the trend turns around. So I'll be looking to exit physical metals. I can always get back in later. But I think 2026 is going to be a difficult year for metals.
Strong charts don't mean easy money when volatility becomes the dominant feature. As Chris Vermeulen points out, gold's 15% tactical run followed the same blow-off and correction structure, now appearing across silver and platinum, signaling rotation rather than fresh leadership. Historically, precious metals suffer sharp drawdowns late cycle. Gold fell over 30% between 2011 and 2013, despite long-term bullish narratives. The split between never sell holders and active risk managers matters because trend reversals punish complacency. A projected 2026 correction isn't bearish. It's how long-term opportunities are reset. What comes next reframes why timing matters more than conviction.
For traders like yourself, whenever anything gets more volatile, like in the case for metals, is that a scenario or a reason for you to get in or excited about getting into the market right now? Let's suppose you're out of the market because of this heightened volatility. Keep in mind the prices, especially for gold, for example, have been consolidating sideways for quite some time, and we're finally getting this up and down volatility that traders dream about. So how do you see it?
Yeah, when there's this type of volatility, like gold still has a very nice chart.
Yield narratives sound attractive right when price risk quietly increases. Offering up to 4% yield in gold sounds compelling, but yield strategies tend to expand when volatility rises. Precisely when counterparty and duration risks matter most. Gold's sideways consolidation followed by sharp swings Maros pass pre-correction phases, not stable accumulation zones. As Chris Vermeulen hints, traders love volatility, but investors must ask who absorbs the downside when price snaps back. Yield doesn't remove risk. It repackages it. The next section explains why volatility itself may be the warning.
I still think gold has got the target to reach around 51, 5,200, I hope, to the upside. But when we get this type of volatility, David, I really don't want to be holding stuff because I know it is a roller coaster ride and it could reverse. It's usually a sign of weakness. It's usually the market is running out of steam. There is a reversal coming. And the thing is, we're in this parabolic explosion phase in precious metals. And you just have to have your finger on the trigger. And I'm remaining long. But as you said, this type of volatility, I don't really like to be involved in stuff when it's like this because now it's the underlying trend is still up. We're just going to ride that trend until proven wrong, till that trend has changed direction. But you got to be cautious because this type of price action is pretty scary. And the monthly chart of silver is such a great way to look at what's going on. When you zoom way back in time, you get these giant spikes that go straight up and they usually don't end very well. And I keep seeing I mentioned, this the other day online, and of course, everybody's like, this time is different. This is, everybody says that each time. But to me, this is a very crowded trade. People have all moved into everything that says the word metals and mining into it. We're seeing just stocks and everything shoot higher. But I'm very, very weary of where this will be probably 2 or 3 bars from now, which is 2 or 3 months.
Parabolic upside feels strongest right before momentum quietly breaks. Gold targeting $5,100 to $5,200 aligns with measured extensions, but Chris Vermeulen's discomfort with volatility echoes prior cycle tops where spikes preceded sharp reversals. Silver's monthly history shows vertical moves often end within 2 to 3 bars, roughly 60 to 90 days, before mean reversion hits. Crowded trades amplify exits because liquidity vanishes simultaneously. Staying long isn't blind optimism, it's conditional discipline with tight risk control. What follows shifts from price action to cycle timing.
January is a huge month for the equities market. If the month closes positive for the candle, we usually have a positive year for stocks. If it closes negative, it could be down. You and I, in our last talk, we talked about the cycles at play, the Benner cycle at play, that are pointing to precious metals and the stock market and the economy weakening and pulling back. And, if we were to just look at this is a monthly chart of silver that I kind of already drawn on. This red box brings us up to about 5,200 in gold. In the perfect storm, gold will move up to 51 or 5,200 in the next month or two. It'll be a very explosive move. Who knows where silver, platinum, and palladium will go? They could go very high. But then we're going to go into a big correction, potentially a 20 to 35% correction, very similar to what happened in 2007, 2008. We saw that pullback, and then we start into another multi-year big move up where I think we see $7,500 gold and beyond. So I'm still really bullish on metals long term, but I think we're going to walk into this roller coaster ride in 2026, because when gold has these parabolic moves and breaks out of these ranges, just like it did in 2006, 2007, it's usually a warning that something bad is brewing and unfolding. And so gold is pricing in for that.
Explosive upside often signals stress, not strength. January's market signal matters because historical data shows negative Januaries precede weaker equity years nearly 70% of the time. Chris Vermeulen's comparison to 2007-2008 is critical. Gold surged before broader financial stress surfaced, not after. A 20 to 35% correction doesn't negate a $7,500 long-term thesis. It defines the cost of ignoring cycles. Parabolic breakouts are warnings, not celebrations. Next, the real risk isn't missing upside. It's misreading the signal.
Gold, that's why gold has gone from 2,000 to, 2,200, 23 or 4,300, is because it's already pricing in instability, things breaking down. And I think there's some upside. I know you and I, when we talk about this, and I always reference 2007, everybody's like, well, this is nothing like 2007. And I fully agree. Price does the same thing. It doesn't matter when somebody hits that sell button or the buy button, the market doesn't care what the news is. It's either people are buying from greed or selling from fear, and you just have to identify this. So there's no doubt the market condition we are in right now for precious metals is different. It always is different. And there's definitely some very strong signs that something big is brewing, with lots of gold going overseas to Shanghai. We're seeing institutions, we're seeing a lot of big buying, but by big firms and things, the central banks, right? So there's definitely something brewing. But again, you can't just buy and hope. People have been waiting up for this move in silver, and a much bigger move in silver for like 20 years, 25 years since I got into this. So I like to take profits, play the charts, not the expectations or the news.
Gold didn't rise quietly. It screamed instability long before headlines caught up. The move from roughly $2,000 to over $4,300 isn't about optimism. It's about risk repricing, just as gold front-ran stress in 2006 to 2007. Massive physical flows to Shanghai and persistent central bank buying, especially since 2022, signal institutional fear, not retail enthusiasm. As Chris Vermeulen emphasizes, price behavior reflects emotion, not narratives. And waiting decades for silver has trained investors to confuse patience with discipline. Charts reward exits, not hope. Next, Chris Vermeulen explains why gold's next move may punish passive conviction.
Gold, similar question for gold, but gold has not had this kind of parabolic move in recent weeks, but similar question, Chris.
Yeah. I think this chart kind of shows it. I still think we could see gold move up to 51, 5,200, and then I think it's going to pull back. I think that's going to happen in 2026. The pullback might be short-lived. It might only be 3, 6, 9 months, and then boom, we're back off to the races and heading higher. But obviously, if it does pull up to this 51, 5,200, it will have a really steep correction, I think, a very sharp one, and it'll be a huge opportunity to either buy more or to get back in, depending on if you sell, once it starts to peak out here. But I do believe we're going to see gold try and grind higher still for another month or two. And then I think we're going to see a very sharp pullback. But I think by the end of next year, gold will already have bottomed and same with silver, and will be moving higher. And I think it'll be a great time to get into, I think, miners. I think that's when miners are really going to explode. They're going to build a base here over the next several months or 2026, and then I think we're going to see a very big move together.
A slow grind higher often hides the sharpest drawdowns ahead. Targeting $5,100 to $5,200 aligns with technical extensions, but history shows parabolic gold moves are followed by violent corrections. Gold dropped nearly 30% after its 2011 peak. Chris Vermeulen's focus on miners lagging now is key, since miners historically base during metal corrections before leading the next cycle. Short pullbacks feel harmless, but steep ones reset sentiment and capital positioning. Opportunity favors those waiting for structure, not momentum. Next, the cycle comparison to 2007 becomes unavoidable.
So I think by the end of next year, the precious metal space will be very exciting, similar to what we saw in 2007. It's fairly short-lived correction, and then boom, you just head off into a multi-year rally, and you'll want to own probably a lot of metals, a lot of miners, and probably uranium and whatever the new big sector, which will probably be like data centers and AI and robotics, during the next major bull cycle.
Big rallies are built during boring, painful corrections, not headlines. The 2007 parallel matters because metals corrected first, then launched into multi-year runs as liquidity shifted and real assets repriced. Miners and uranium historically outperform once capital rotates away from late cycle equities, while new growth themes like data centers and AI absorb excess liquidity. Chris Vermeulen's framework isn't hype, it's sequencing. Investors who survive the correction get paid for patience.